All right, let's dive into industrial packaging giant Greif Inc. After their latest earnings call, the market got some seriously mixed signals. You had headlines all over the map, leaving a lot of investors scratching their heads and asking, what's really going on here?
So what was all the confusion about? Well, look at this. On one side, you have Zach saying it was a clear earnings beat, but on the other, FactSet is calling it a miss. So which is it? The reality is it all comes down to a company that's in the middle of a massive transformation. Some analysts were still counting businesses that Greif is literally in the process of selling off.
And the market's reaction to all this noise? Pretty much a shrug. The stock barely moved. Now, that tells you something important. It tells you that the smart money was looking right through the confusing headlines and focusing on a much, much bigger story.
So, what is that bigger story? I can tell you it's not about one single quarter's results, not by a long shot. It's about a fundamental, top-to-bottom corporate reset.
And that brings us to what we're calling Greif's big portfolio reset. You see, the company is making some huge, deliberate moves to reshape itself. They're trying to become leaner, way more focused, and, this is key, a less cyclical business.
And you don't have to take my word for it. The CEO, Ole Rosgaard, said it himself. They're sharpening the portfolio to focus on markets where they have the greatest ability to grow. I mean, that's just a classic business playbook, right? Sell off the stuff that doesn't fit to double down on what you're best at.
And listen, these are not small tweaks. They're selling their entire containerboard business for a whopping $1.8 billion. And on top of that, their Timberlands unit is going for nearly another $500 million. These two deals are literally going to change the entire shape of the company.
So what does this all mean for their wallet? Well, after taxes and all the fees, Greif is expecting to pocket about $1.75 billion. In cash, that is an absolutely game-changing amount of capital to have sitting on your balance sheet. Now, before we see just how big of a deal that is, let's do a quick primer. A company's leverage ratio is just a simple way to measure its debt compared to how much it's earning. All you need to know is the lower the number, the healthier the company, and the less financial risk you're looking at.
And here's the payoff. Greif's leverage is about to absolutely plummet. It's going from 3.1 all the way down to under 1.2. I mean, that takes their financial risk profile off the table and gives them an incredible amount of flexibility for whatever they want to do next.
Okay, so that's the grand plan. It sounds good on paper, but is it actually working? Well, the numbers from this quarter suggest the answer is a huge, resounding yes, and that's even before the big cash from those sales has hit the bank.
Honestly, this slide tells you everything you need to know. Get this. Even though their revenue actually went down a little bit, their profitability, their adjusted EBITDA, surged by 11%. This is perfect proof that their new value over volume strategy is the real deal. They're making more money from fewer sales. That's efficiency.
And the cash flow? Oh, it was just staggering. Their adjusted free cash flow was up nearly 400% compared to the same time last year. Just incredible.
So how are they doing it? Well, it comes down to aggressive cost discipline. They've already locked in $20 million in run rate savings, which puts them right on track to hit their full-year goal. And this isn't just talk, it means making tough calls like shutting down an entire plant to make their network more efficient.
And all this confidence is showing up where it matters most. Their guidance for the future. Management actually raised the midpoint for both profitability and, more importantly, for free cash flow. When a company raises its cash flow forecast, that's a really, really strong signal to the market.
Okay, so the execution is strong, no doubt about it. Now, let's put on our analyst hat for a minute and look ahead. What could a company like Greif actually do with all this new financial firepower? Well, here's one bold, but I think very plausible idea for what we might hear on the next call.
I mean, just think about it. You've got a war chest of cash, a rock-solid balance sheet with almost no debt. The question really isn't if Greif is going to make a big move, but what kind of move it's going to be.
So here's a potential play we're calling the stealth shareholder reward. Follow me here. Step 1 and 2, they get the cash. Then, instead of going out and buying another company, what if they reward their shareholders directly? They could announce a huge one-time special dividend and launch an offer to buy back a ton of stock at a premium price. And the best part, they could fund all of it with the cash they have and then just add back a little bit of cheap debt to get back into their normal target leverage range. What this really is a self-funded, leveraged recapitalization. I know, it's a mouthful, but it's a super bold move that would signal supreme confidence in their new, leaner business model, all while making every single type of shareholder very, very happy.
Okay, let's pull back from the speculation for a second and bring it all home. Let's get to the bottom line. Here are the key things you need to be watching for and our final take on the stock.
So, in the short term, here's your checklist. First and foremost, you want to see both of those big sales close successfully and on time. After that, keep an eye on their cost savings. Are they staying disciplined? Watch for any rebound in their Q4 volumes, and of course, any more updates to that full-year guide.
So, based on all of this analysis, we're assigning an outperform rating to Greif. The company is successfully executing this massive portfolio transformation. They've dramatically strengthened their balance sheet, and they've proven they have real cost discipline. All of this puts them in an incredibly strong position to create some serious value, especially when the broader industrial demand eventually starts to pick back up.
And that leaves us with one final, kind of provocative thought to chew on. With its mountain of cash and its newly sharpened focus, has the new Greif positioned itself as a predator, ready to go out and acquire its competitors? Or has it just made itself a much more attractive, streamlined target for an even bigger player to swallow up? And as always, just a quick but important reminder, this is not financial advice. All of the analysis you heard today is for informational purposes only. Please be sure to do your own research before making any investment decisions.